just by way of introduction, wanted to introduce the panel. So to my immediate left is Josh Pinzer, who is the head of iShares Institutional Fixed Income at BlackRock. To his left, we have Eric Eisenberg, who's the head of Fixed Income Portfolio Management for Quantitative Beta Strategies at JP Morgan Asset Management. And finally, Bill Amity, head of SPDR Fixed Income at State Street Global Advisors. So just by way of framing up our discussion for about 30 minutes, we're going to touch on, I would say, 4 major themes and topics. So we're going to talk a little bit about the industry as it relates to flows both into and out of fixed income ETFs. Next, we would talk a little bit about new adoption, maybe some of the new growth that we're seeing among market participants, specifically in the fixed income ETF industry. Next, we'll talk a bit about what's driving that increased adoption and growth by looking at some of the innovation that we're seeing among developing new strategies and new products. And then finally, talking a bit more about some of the elements of trading and risk management. So right now, if we're looking at the U.S. fixed income, the U.S. ETF industry, right about 4.2 trillion in total assets. Of that, about 823 billion is in fixed income ETFs. So we contrast that with about 250 trillion of global debt. There is a significant amount of catch-up that the ETF industry could make. Year to date, we've seen about 126 billion of net inflows into fixed income ETFs. And I think it's also worth pointing out that over the last 3 years, fixed income ETF AUM has been compounding in excess of 20%. So with that, Josh, first question for you. What do you attribute this growth in fixed income ETFs year to date? And what are some of the themes that you think investors are trying to capture by a lot of these inflows?
Sure, 100%. So thank you for hosting us, and thank you to Quantify for this panel. So it's been actually an unbelievably exciting year, I think, for fixed income flows. You heard some of the stats. By our calculation, actually, we have the bond ETF industry hit $1 trillion in June globally. And that is from 0 17 years ago. We actually think that we can get to the next trillion, to hit 2 trillion in total within 5 years. So when you hear some of those growth rates and the flows overall, it's pretty dramatic and pretty impressive, pretty exciting. So what's behind that? So I would say we see 3 or 4 key themes. I'll pick on 2. So the first is really institutional adoption. We'll talk about that in a second in terms of this is not simply a wealth product anymore. That might have been where it started. It is not where it is going. And the second piece, again, is really around portfolio construction, which I think is perhaps pretty relevant for this group here, which is how investors are thinking about building portfolios now. They're really thinking about exposure. They're thinking about alpha. They're thinking about factors. They're thinking about index. And as those tools develop, as the analytics develop, as the ability to achieve a specific outcome develops, portfolio construction is evolving. So the 2 big themes I think that we see in terms of flow year to date have really been around sort of that construction, that use case perspective. So about half of the flow year to date has been in corporate or treasury rates products. And again, that tells you people are being really tactical and thinking about liquidity in their portfolio. And the other flow that has been super compelling to us, I think, is that I think it's top 5 of US bond ETF flow year to date is actually a mortgage ETF with almost 7 billion in flow year to date. And so to me, that's actually a different portfolio construction use case. That's around building portfolios efficiently, as opposed to having hundreds and hundreds of mortgage pools and operational issues, thinking about the ETF as a tool for portfolio construction a little bit differently. So as we take a step back and assess the year and think about flows, that's where we start.
Great, thanks. And Bill, what are your thoughts? Kind of what are you seeing from State Street's perspective?
Sure. So as you said, about 130 billion year to date in fixed income ETFs, and it's been pretty positive across every asset class within fixed income, with the exception of maybe loans and emerging markets. I mean, loans have seen about 40 weeks or so of outflows regardless of the wrapper. So that's been, I think a lot of that's coming from the, people moved in at the end of 2017 because there was a float adjusted product. And with rates going up, that was interesting. Now they've kind of reversed course on that. But we've seen really, I think, a couple things. Why are they moving into it? One is just the search for yield. That's why they're going to fixed income, right? With global debt, the amount of 14 trillion of negative debt. You've seen central banks are very accommodative. And I also would say that the fixed income ETF kind of ecosystem that we all know has gotten a lot better. It continues to improve quarter over quarter, year over year. And that's really the banks that are supporting it and trading it. We're all ETF issuers here. We do a lot of time educating clients. And as Josh said, it's really, you've seen institutional adoption of the product. And we'll get more into that later. But it's really about the soundness of the product itself and the infrastructure around it.
Great, thank you. So Eric, JP Morgan launched their first fixed income ETF in 2016, I believe. So kind of where are you guys seeing flows so far year to date? And how do you see fixed income ETFs being used?
Yeah, it's a good question. And you know, when you're late to the game, I think you have the advantage of, you know, kind of looking at the competitive landscape and seeing where you can be thoughtful and kind of building out your own product set. And I think for us, what we heard and we've continued to hear from a lot of our clients is that, you know, when they were getting into equity ETFs, they were fine with getting into passive and getting into that market cap weighted strategy. When they get into fixed income and they start to talk about getting into the most indebted companies, that does cause some concern for some investors. And for us, we see that really as being an opportunity. And so where have we seen some of the growth and where have we seen some of our product launches? It's been in products that are a little bit differentiated, a little bit further away from just overweighting the most indebted companies. And so what we've seen more recently, you know, as we launched in 2016, you know, 2017, 2018, those are big drivers for shorter duration products. Our short duration product has hit nearly 10 billion since launching at that point. So, you know, it's one area where we were able to kind of take an existing product team that, you know, had a strong track record and build out a compelling product offering and bring that to market. So, you know, we're going to probably continue to do more of that. And we do see really equities as being the blueprint for fixed income. And so you've seen this general trend in equities towards more strategic beta type strategies. We see an even bigger opportunity in fixed income just by virtue of the nature of how those indexes are constructed.
Great, thanks. So
I will say, by the way, that if I think we are collectively early to the bond ETF game. When you think about bond ETFs are not even 1% of the overall fixed income market. So the opportunity for growth here is really across the board, which is part of what makes it super exciting.
All right, so shifting gears a little bit to talk a bit about adoption and growth of some of the players that we're seeing in the fixed income ETF markets. I think to Josh's point earlier, you know, shifting kind of this perception that ETFs are a retail type of product. I think it's notable that you've seen widespread adoption, not only among allocators, but also, you know, hedge funds, other asset management firms, a lot more tactical players. You've also seen pretty widespread adoption in the insurance space, which I think is pretty interesting for a lot of people. So Bill, you know, among some of these more tactical players, you know, what strategies are necessarily resonating? How are they using them? How is your team helping to facilitate trading, not only in a lot of the secondary markets in the ETF, but in the underlying markets as well?
Sure, thanks, Fred. So I think tactically we're seeing two major drivers. One is to help manage cash positions and liquidity needs, and another is really to adjust your duration or credit risk profile. You mentioned insurance. Insurance is pretty interesting. If you think about 2018, insurance companies traded $16 billion worth of fixed income ETFs for all of 2018. That number in and of itself is not that great. If you think about high yield trades about 10 billion a day. But what's interesting is that in the first half of 2019, the insurance companies hit that number, trading $16 billion again of fixed income ETFs. So insurance companies are starting to trade them more. They're starting to hold them more. There have been some adjustments in terms of regulation that's making it a little bit more user friendly for insurance companies to use fixed income ETFs. So I think that's a big area of growth. But also, you know, tactically, we've seen active mutual fund managers using fixed income ETFs. And we've also gone as far as seeing active mutual funds using actively managed ETFs in their funds. And that's, you know, really driven by the liquidity of the fund, helping them manage cash. I think 3 or 4 years ago, when I was having conversations with these types of portfolio managers, they really didn't want to have a product with the biggest gripe was paying a fee on a fee, right? Yet these managers would be using a credit default swap, a total return swap. And I think really the risk profile of an ETF is more in line with their overall cash portfolio. So it makes sense to use that as a type of instrument. And liquidity has grown to the point where they can just trade 20, 30, 40, $50 million at a clip relatively easy and seamlessly. And there's been much more buying and adoption from the top of these firms to say, quite frankly, a lot of them are launching their own ETFs, to say that, okay, this makes sense. You were using X product, but you can also use ETFs in your strategy as part of your strategy to help manage, your risk profile or your cash inflows, outflows.
And so, Josh, I know that BlackRock was largely instrumental in helping get the National Association of Insurance Commissioners, which is a national regulatory advisory group that oversees the general counsel of a lot of insurance companies. Kind of what was BlackRock's role and kind of what were some of those conversations to get them comfortable with basically putting bond ETFs on a level playing field with individual cash bonds?
So I think it's, what's interesting is we spend a lot of time talking about insurance companies. Why do we spend a lot of time talking about insurance companies and bond ETFs? It's not just that they own a lot of bonds, is that I think with all due respect to the industry, they don't move so fast to change processes and the way they think about managing money. So the fact that, as Bill talked about, at the end of 2017, the largest ETF holding for the insurance industry overall wasn't an equity ETF, it was a bond ETF. So that fact in and of itself is pretty profound. And why could they do that? It actually is our clients were asking for it. So, it's really partnering with folks like State Street and the team there in helping our clients talk to regulators to make sure that bond ETFs are treated, what we like to say is actually a substantive risk assessment, right? The wrapper is just a wrapper. It's simply a portfolio of bonds, whether it's in an ETF structure or it's in a separate account. The risk characteristics are the same. The treatment should be the same. So in the insurance space, and to be fair, you should consult your lawyers and auditors. And this is not tax or legal advice. In the insurance industry, you can actually, for statutory accounting and capital purposes, put a NAIC rated, an SVO rated bond ETF on your bond schedule. So it gets bond-like treatment. And even more, we're seeing that grow and change. I think that we're having conversations with insurance companies to engage people like the Federal Home Loan Bank to be able to put bond ETFs to serve as collateral for certain collateral exchanges. Actually, a Treasury bond ETF gets the same or worse capital treatment or haircut as Netflix stock, which is a little, counterintuitive might be an understatement. And then you think about other things that are happening. So Texas actually passed a law that was effective this September that allows for insurance companies with Texas entities to build portfolios of bond ETFs subject to certain restrictions and actually put bond ETFs on what they call deposit or basically collateralized business that they have in Texas. So we see the regulatory and accounting landscape shifting. And I think this is just the beginning of how that's evolving for everyone.
Thanks. So Eric, I think you're in a somewhat unique position that in addition to working on the ETF side of the business, obviously being part of a larger asset management organization, just kind of curious if you had any insights or thoughts, kind of unique advantages, disadvantages, kind of how you're seeing ETFs being used among external clients and internal clients as well.
Yeah, it's a good question. I think, we talk about insurance companies being slow movers, and I think in many cases, the larger asset managers can be slow movers as well. And so, I just see an enormous amount of opportunity for asset managers to make greater use of fixed income ETFs. If you think about it just from a building blocks perspective, a lot of asset managers are dealing with multi-asset type solutions, and having those building blocks that are cost effective, that have greater liquidity, that have greater transparency, it is actually a pretty interesting and compelling product set for them to use. So I do see them making more and more use of it. With that being said, the demand is coming, and certainly I would say we do see fee compression happening across the board. And as more and more fee compression takes place, we do see that shift to fixed income ETFs and to some extent to fixed income passive accelerating throughout asset management. And so, within asset management, within wealth management, not speaking about JP Morgan specifically, but we're talking more broadly across the industry, there's going to be widespread pressure on them, to look for ways to, reduce their fees. And again, as we see more of these, solutions type offerings, and, we go out for RFPs all the time where we see a lot of clients are coming to us for kind of an integrated solution. What are you going to do across the fixed income landscape? Fixed income ETFs offer an ideal building block to solve that problem. And I do think you'll see much more of that going forward.
Yeah. So, Josh, anything to add there in terms of what you're seeing from BlackRock's usage of ETFs in other?
Yes,
strategies?
I think it's a good question. I actually think Bill touched on it that I'll build upon. The way we've thought about it is the bond market is actually modernizing, right? ETFs are playing a pretty significant role in modernizing the bond market. So all of these investors are actually touching ETFs, whether they know it or not. So if they're a large asset manager trading individual bonds, the sell side broker is using ETFs as a hedge. If they are an insurance company trying to shift portfolios from high credit to lower quality credit, they can do it in trades that are then used with ETFs. So the idea that that all of us that are affiliated and know bond portfolios or responsible for bond portfolios for clients aren't involved in the bond ETF market just isn't true. So when you think about the adoption, it's directly related to that changing of the bond market overall. It's why you see the asset managers doing it, people, a place like BlackRock. I think the interesting point is the largest users of bond ETFs are actually active managers. So, and that is a function of the way the bond market is changing.
Great. All right, so moving on to innovation in product development. So if I'm looking broadly, U.S. ETF industry, just over 1,900 equity strategies. You got about 460 fixed income ETFs in the U.S. So year to date, you've seen about 161 new strategies launched in 2019 versus 38 in fixed income. So if you kind of break that down, you've got about a 20% or so level of kind of like new launches there. In terms of new opportunities, Eric, what are you guys thinking in terms of innovation on the product development front as a newer entrant into the space?
Yeah, so I alluded to this earlier, but I do think that as we go out and we talk to clients about just investing in the most indebted companies, I do think there's an opportunity to move beyond simply debt weighting. And if you think about how these indexes are structured, take like the Bloomberg Aggregate Bond Index, for example. It overweights the most indebted companies. So a company issues more debt, and what happens? Well, it has a larger weight in the index. Its fundamentals deteriorate, right? Its net leverage goes up, its interest coverage ratio goes down, and it's more likely to be downgraded, and potentially downgraded into a market like high yield that couldn't necessarily absorb it. And so we look at what's happened to the bond market in general over time. And if I go back to 2000, the ag was probably 25% of the corporates were triple Bs. Go to 2008, it's about 33%. You go to today, it's more than 50% triple Bs. $3.2 trillion worth of triple Bs, and yet the entire high yield market is about $1 trillion. And so I think to when I was managing high yield back in 2016, when we had like the energy market crisis, and the question comes up of like, who's buying high yield at that time? And at that time, it's highly correlated to equities. They're worried about liquidity. You see kind of like a run for that exit door. And so what would happen if there was a wave of downgrades? The index products would be forced sellers at exactly that worst time. I've managed fixed income ETFs. I'll tell you, if I'm managing a passive ETF that's tracking an index, I'm going to sell at 3 p.m. on the close on that last day. Whatever the price is, my objective is going to be minimization of tracking error. I don't need to outperform by buying beforehand or by buying afterwards. My objective is to sell at that point in time. And so, if everybody's getting out at that same time and the price goes way down on the last day, well, that's what I did. I matched it. But I do think that there's an opportunity to do something a little bit better. And so what we see is the rating agencies, the flaws that existed in 2008 where the rating agencies are basically being paid by the issuers, that hasn't changed. And so right now we see just rating agencies encouraging more and more companies to be at that triple B level and not downgrading them. So we do see certainly opportunities with the market dynamics within fixed income to offer something that kind of veers away from investing in the most indebted companies. We've launched some products around that perspective, and I think you'll see more of that from JP Morgan in the future.
Thanks. Bill, you guys recently launched a sector rotation bond fund, which I think is pretty novel for the industry. You've also had a fair amount of success launching actively managed fixed income through your partnership with DoubleLine and Jeff Gundlach. Kind of how are you guys thinking about, a lot of the white space in ETF product development, specifically as it relates to fixed income?
Sure. So I think rather than talk about a specific section of the market, it could be also about the wrapper or the presentation of the ETF, if you will. For example, models. Models are really taking over in terms of in the intermediary space, right? Advisors want to just buy a model that tells them where to go and can kind of tactically shift. That's what we did launch an ETF that will rotate your fixed income exposure for you. So we're seeing that area of the market grow. And within those models, obviously, fixed income ETFs will play a big part. The other area of the market that's interesting is, as Josh kind of mentioned, with respect to new use cases of ETFs, the ETFs as collateral instruments, right? So rather than using it as just a risk instrument, think about an ETF as a collateral instrument. You talked about the Federal Home Loan Banks, which are looking at adopting for certain insurance companies and regional banks accepting fixed income ETFs as collateral. And one of the issues there is that the look through on that is a lot of folks will look at it as an equity, right? So they'll just look, what is it trade on exchange? And that's the volume. So, we have a treasury ETF, maybe a 3-month T-bill ETF, where it'll be viewed as what is the volume of that ETF on the exchange, rather than the look through into the depth of market in the T-bills. So that's a slow process to change, but I think as more segments of the market are accepting ETFs as collateral, that will continue to change. With respect to some of the active funds, I think there's still a lot of opportunity in the active space. We at State Street, our ETF business is part of our broader fixed income beta business, which is about $400 billion. But what we've done is gone outside of State Street to leverage best-in-class active managers for certain active strategies, whether it's, you mentioned DoubleLine in more of an ag-based type of strategy, GSO for loans, et cetera. So we always continue to try and identify key areas of the market where we think that managers have an edge.
Great, thanks. And Josh, so iShares launching first fixed income ETFs back in 2002. You guys offer a tremendous amount of choice, both different slices and sectors of fixed income, points along the yield curve, largely viewed, I think, in the market as great tools for asset allocators, different ways that people can tactically position. How are you guys thinking about actively managed ETFs? Is it possible that we'll see, leveraging some of the fixed income expertise from the wider BlackRock organization? How are you guys thinking about product development?
So a couple things. First, we already have a number of actively managed ETFs in our suite. So it's definitely something that we've done. Where we see the growth, though, I'm going to build a little bit upon what Eric was saying and maybe extend it, are two areas. So the first is on the ESG front. So we see that as an area, look, in particular in Europe, clearly, today, for example, there were two high-yield corporate ESG launches from iShares in Europe, UCITS products. So we're seeing that demand grow. We think that's coming to the U.S. I think it's inevitable. We're certainly having folks ask about it more in the wealth space and the institutional space. Again, though, I think that's going to be a trend. And then the second piece is, we do think factor-based ETFs, which is a little bit what Eric is talking about, although the way he talks about it, bonds in general are very scary, and they represent indebtedness, which is definitional. So we can disagree a little bit about your characterization of bond ETF and bond investing, but we do think that you can actually explain a lot of returns for portfolios and for active managers through the lens of factors, through the ideas of credit risk, through the ideas of interest rate risk. And we think that there are probably smarter ways. I go back to that portfolio construction idea, that there are probably smarter ways to build portfolios overall. As a result, there may be differentiated ways to build ETFs to help along that front. I do want to address one misconception that Eric mentioned. Talked about forced sales, bonds and bond ETFs. That's actually not correct. Portfolio managers and bond ETFs have the latitude to manage around risk, and in the sense that might not even be limited to downgrades, but they're monthly rebalances. ETFs are not managed by robots; they're managed by people. and their job is to minimize tracking errors, he rightly points out, as the fiduciary to the index. So there's a lot to think about in there. There's a lot to unpack in terms of how you're using the ETF. And I think that's right. There are places for factors for building portfolios. They may be better, they may be worse. I think it depends on what you're trying to optimize towards.
Yeah, and I guess maybe just a broader question for the rest of the panel. Are you guys seeing additional interest from clients as it relates to factor-based portfolios? It's certainly very prevalent on the equity side of the business. Is it something that we're also on the cusp on the fixed income side?
I think that part of the challenge with fixed income is one of data and risk management and understanding the sources of return. So we are getting further faster in that space. So I think it will start to accelerate. Clearly, again, as was pointed out, this is an area that is young, bond ETFs in general, but certainly factors within the bond space. So we'll definitely see more growth there. I think there's a lot of work to do to convince institutions to think about their portfolio through that lens. So when I just put my institutional hat on, there's definitely growth. But clearly it's a bet you were making.
Yeah, I think without a doubt there's some challenges even in the implementation of factors in fixed income. If you think about turnover, if you think about transaction costs, meaningfully deviating away from the index does come with those challenges. Even trading during periods of market stress and trying to realign yourself to the targeted factor weights could be somewhat of a challenge. With that being said, I think we see more and more industry players trying to tackle those challenges, and the index providers are more well positioned to handle that type of thing. And kind of, I guess, getting back to your earlier points, I shouldn't imply that they are forced selling, but I would say that if you are tracking an index and the objective of that index, is your objective of your fund is to track an index and it does want to sell those bonds that are downgraded, at some point you do need to sell. And that's your objective as a portfolio manager. And I think factors can kind of take you away from that and give you something that's a little bit differentiated from what's out there right now.
Thanks. All right, so now focusing on the element of trading and risk management. So my personal view is that I think that one of the most underutilized resources at an ETF issuer or ETF sponsor is their capital markets team. So this capital markets function, a lot of times it's former traders from a lot of banks or authorized participants that really understand the nuts and bolts of the ETF ecosystem. Almost every ETF sponsor has one, and I think they're a great resource for kind of understanding the underlying mechanics in terms of how to get exposure or also liquidate that exposure on the way out. So, Bill, just what are some of the biggest mistakes that you've seen from clients over the years in terms of how they're sourcing liquidity as it relates to fixed income in an ETF? And then just talk through a bit of the best practices as well.
Sure. So I agree with your point. Capital markets teams are prevalent at most of the ETF issuers, and they are a free and should be a valuable resource for everybody. Our team, we've got folks who have traded individual bonds, bond ETFs, so can really go into the weeds on what's going on. Some of the certain things that we've seen apply to all ETFs, but in particular market orders, right? We encourage people not to just put in market orders, especially at the beginning of the day or the end of the day. Use limit orders. Be mindful of the premium and discount in a fixed income ETF. There's some nuances into how different ETF issuers benchmark their NAVs, and it's important to understand as an investor what that premium and discount is based on how they're marking the price of their ETF NAV, and also understanding what's really the volatility of that premium and discount, right? You can have an ETF where the market's not moving and you may pay 20 basis point premium, but if there's a lot of volatility in that premium discount, you may end up selling it at a loss just because of the way the ETF is structured. Also, timing of the order is important, right? You want to be mindful of what time you're trading the order and really understanding the size of the order relative to the ETF and relative to the underlying market. If you think about the growth of an ETF, they start off with some seed capital, and as they grow, many of the orders that come in, the incremental buys that come in, will result in a creation, right? So end investor A buys an ETF, the authorized participant sells it, buys bonds, delivers it to an issuer, and shares outstanding grow. As ETFs continue to grow and develop, they start to become more of trading tools. And you'll see that with some of the high yield ETFs, some IG ETFs and things of that nature, where there's you can trade a bigger size, and a lot of times that trade doesn't hit the underlying market. It's just bought and sold in the ETF. So having a good understanding, really leveraging that capital markets team that can walk you through all these different things and ways to think about it, I think is really important.
And Eric, can you talk a little bit? I think you've got a unique perspective given you're the one that's actually selling or buying the cash bonds in the ETF. Can you talk a little bit about the evolution of the ecosystem there in terms of how you're interacting with authorized participants or market makers, or kind of how that's flowing through to your investment process?
Sure. So I mean, I think the one big change that we've seen, which is a really recent change, is the adoption of the new ETF rule. For those of you who don't know, prior to the ETF rule, it wasn't really a level playing field in terms of what all ETF issuers were able and capable of doing. And so a few of the incumbents had the ability to do something called negotiated baskets, where you could basically swap in a basket of bonds and receive shares of the ETF, or do that the other way. And so some of the tax efficiency and some of the flexibility that you get with a fixed income ETF was lost on some of the newer entrants into the ETF space. And so, they've recently changed the rules on that, and I think it takes effect just before the end of the year. And so in my mind, that's really going to be a game changer, because it will allow all ETF providers to offer something that's consistent, and that delivers the same, expected results that you would get from the other initial providers. In terms of,
by the way, it's a good thing. We agree.
All right. I was careful not to mention
No.
any providers.
Very, very supportive. It's a very good thing.
But certainly, obviously, I think anybody who's later to the game is a big supporter of it as well. Mm-hmm. In terms of actual trading, I think the pace of electronification in trading in fixed income has just been, incredibly rapid and surprising to me. We've moved to no-touch trading, in a very short period of time, and we're doing it across all asset classes of fixed income. We're doing it in investment grade, we're doing it in high yield. You start to see it in munis. Areas of the fixed income landscape that you thought it would never really touch, it's really starting to happen right now. Portfolio trading is something that's also, up and coming, and is probably going to be making a big difference, where you can basically go to one dealer and you could say, hey, I want to trade in a basket of bonds, and they're going to give you a quote for that entire basket of bonds. And so you're starting to see, if you wanted to trade at the close and you wanted to get execution, that's going to be in line with a price that's at your index level. It's going to be easier and easier to do that. So, in terms of what we're seeing, in terms of the breadth of the market, in terms of the number of market participants who are willing to trade at smaller sizes, the ETF, as you were talking about earlier, the ETF ecosystem creates more of this. As there's more and more trading into the ETF, you see more and more trading in the underlying bonds, and that creates liquidity across the ecosystem. And we're all the beneficiaries of that.
Nice. And so, Josh, I've seen you write some interesting pieces as it relates to using ETFs in place of something like Treasury futures or total return swaps, just kind of understanding the cost-benefit analysis there. Kind of how are you seeing ETFs step into some of those other maybe more bespoke types of products in ways to get exposure?
Yeah, I mean, look, the ETF is a tool, is an index tool just like any other. And that means that whether it's a future or CDX or total return swap or an option, and if you traffic in any of those instruments and you're not considering the ETF with that, you're missing some potential relative value opportunities. It's part of the reason hedge funds have become so active in it. And to build on a little bit what Bill was saying around capital markets, a lot of the work that we collectively do is around technology and trade comparisons and relative value comparisons. And if you're not having those conversations or building them yourself, that's an opportunity that's missed. But I think it's clear, if you are using an index product, whatever the form of that product, ETFs should be a piece of that conversation, because again, if you're looking to get that exposure, you want to do it in the most effective way to optimize for your objective. If you want leverage, you could use an ETF option. If you want to trade, if you need to hedge an exposure, perhaps the ETF is better than CDX, which is not necessarily a perfect representation of the cash market. So again, thinking about what you're trying to accomplish and then the instrument that can best get you that exposure.
Thanks, guys. So I think we're going to turn it over now to some audience Q&A. So I think there might be a microphone that's going around, and if you could please state your name and what organization you're with, that'd be great.
All right.
Thank you.
Hello. So my question is, what is the role that technology is playing in terms of the rise of the ETFs and income and optimization of the transactional cost that is associated with this because the equity market, the transactional cost has really gone down. We can trade with the $0 now. So how do you foresee transactional cost being really optimized with all the technology platforms?
So I'll take one stab at it. One of the things that we do at State Street is this concept of negotiated baskets, right? So let's take an ETF, for example. Maybe we have an ETF that has 1,000 CUSIPs in it. And because of our ability to negotiate with the street on what we accept in on a create or redeem, we're not going to require all 1,000 CUSIPs to be delivered in. So let's say there's authorized participant A wants to create $50 million of that ETF. They may say, well, we'll optimize a portfolio that we're going to deliver to State Street of maybe call it 100, 200, 300 CUSIPs, whatever it may be. So as the portfolio manager at State Street is sitting there saying, okay, does this represent the risk of what we have or what we need for our fund without collecting every single line item in there? Now, authorized participant B might also want to create, right? So now you've got a couple different things coming into the fund. So we're using tools now to make sure that the overall portfolio is optimized and maintains the risk characteristics of the index that we're looking for. So that's one of the main ways we're using even portfolio trading to really help price these out and make sure we're getting fair market prices and making sure our portfolio is optimized in such a way where we're balancing the liquidity needs of it, but also making sure that it represents really the risk characteristics of the fund.
Yeah, and just to add to that briefly, I mean, I think a lot of what he's talking about is on the flows. So when you get inflows, when you get outflows, you can really seek to optimize it. But to your point earlier, even on the rebalancing, when we look to how are we going to change our portfolio to realign it with an index or realign it with targeted weights, we do see definitely that transaction costs are coming down in the sense that we can execute on much smaller sizes electronically with much more counterparties. But even then, we can take advantage of the custom baskets to actually do in-kind create and in-kind redeem to facilitate some of those transactions. It's more tax efficient and it lowers our transaction costs. So I think you're going to see a similar trend in fixed income where our transaction costs do come down and are less impactful to some of these strategies.
Thank you. Arvind Rajan, PGIM Fixed Income. I was wondering if any of the panelists could comment on the potential risks that the rapid growth of the ETF market might pose. Now, I understand that in fixed income it's still small relative to what it is in equities. But for example, already some of the fixed income ETFs are more liquid than many of the underlying instruments. We know that there have been flash crashes in other markets. Do ETFs help to reduce that risk, or do they, in certain instances, make that risk more acute? What types of basis could develop between ETFs and the underlying, in what circumstances, and how will ETFs behave in a tail event?
So the good news is that we actually have a lot of great data to answer that. We've seen over the last, 3, 4, 5 years, a lot of instances where those questions have been tested and answered very well. So whether it is the gating of the, I think it was 3rd Avenue in 2015, HYG, or our high yield ETF, traded its largest volume ever because that's where risk was clearing. The bond market was not clearing risk. In terms of, which I think speaks to, again, no, you are not changing the underlying characteristics of bonds. What you're doing is you're changing the way or the availability of a venue to trade them. So when you think about when you build a liquidity picture, you start, an individual bond is definitionally less liquid than a portfolio of bonds. You have idiosyncratic risk. You build a portfolio of bonds, should be more liquid because now you have a diversification. It's the benefit of diversification. And then what you do on top of that is you put a very clear, rules-based, transparent approach to managing that portfolio. That should, and a new venue to trade it on, or additional venue to trade it on, that is that additional layer of liquidity. It isn't magic. At the limit, the ETF has the liquidity of the underlying. So I think that's a very, very important part of the ETF structure to understand. It's not a liquidity transformation. And then you asked a question around, which is to say that perhaps the differentiation between the price of the ETF and the price of the underlying. And I'll go back to my initial example, which is in market stresses, and I think we've had a number of them over the last 4 years. The ETF trades. Why does it trade? Because the bonds don't trade. So what happens? The ETF will trade at what is seen as a discount to the quote NAV of the fund. Well, the NAV of the fund is based on lagging prices. The NAV of the fund, if someone would trade the fund at that, you would be a very happy seller of bonds. So what happens is the ETF actually provides that market transparency in a moment when the market has no transparency. So you'll often see that, and then the market clears at a certain point, and the price and the NAV and the price of the ETF converge again, because there are rational actors, authorized participants who are trading ETFs. It's definitely an important question to understand, and is the core of the structure and benefit of the ETF.
Just to add to Josh's point there, we went back and looked at December of 2018,
Yeah.
certainly in high yield, and you'll notice that if you look at the ETFs, they did trade at a discount to NAV. But rather than kind of question why that was happening with the ETF, we went and looked at the underlying NAV, which is priced by third-party providers. And what we noticed is, not to our surprise, because we've seen this happen in other instances, like the taper tantrum, is where that underlying NAV, there was a significant number of bonds that did not change price day over day.
Correct.
Or change price by maybe a nickel. And you're talking about the last couple of weeks in December, where seemingly everybody was a seller, volatility spiking, and were those bonds, should they be priced where they were? Probably not. So again, it's that relative price, and so I always encourage investors to think about where the underlying market really is relative to not just the ETF.
So
Would you be willing to say that ETFs don't increase the risks, or don't introduce any new risks then into the market?
No, the ETF in and of itself is not a risk-free instrument. Again, at the limit, it is the risks of its underlying. So I think that's important. And I also sort of turn your question a little bit on its head, which is we worry about a tail event of a sell-off. I think everyone in the room might argue that we've had a pretty tail event purchase or demand, and yet the ETFs function and trade as expected. So I do think that, and then finally, the other comment I would make is, in that instance in December, if there had been no bond ETFs, I would ask the group where they think the bond market would have traded. So I think that it's not simply a question of, what is the ETF doing? I think it's a question of how is the bond ecosystem operating? How was it operating 10 years ago, 5 years ago? How's it going to operate in the future? And you've heard a little bit about how it's going to operate in the future, and the ETFs are a big part of that.
I would like to ask you guys what your views on ETF market for securitized products such as MBS, ABS, stuff like that. Thank you.
Sure. Well, I mean, MBS, we've seen that market start to take off this year. I think a couple of reasons. One is part of the ag index, and what we're seeing is people modify their ag exposure through ETFs. There's a host of ETFs out there where you can kind of put them together and get the same ag exposure. And if that's your benchmark, ETFs are a great tool to kind of modify your duration, your exposures through low-cost ETFs. We're seeing more adoption of, say, mortgage-backed ETFs on the sell side. So the sell side is really adopting. What I mean by that is the MBS traders themselves are 2-3 years ago, they would not want to talk or hear about ETFs. And now many of these banks, those departments are trading the ETFs themselves, talking to their clients about it. So the whole ecosystem with respect to MBS has grown significantly. And it's become an area where you could really trade ETFs at a very tight spread. ABS, I'm not necessarily sure that market is really big enough for an ETF. Right now, I don't think there's any ETF out there in a ABS market.
No, I mean, one thing I would add is you really need a reliable index in the space. And we mentioned the ag. The ag does have ABS, it does have CMBS, but kind of as a standalone index, it's widely tracked. yeah, I mean, there's going to be a little bit less liquidity there. With that being said, I think what we do see is a lot of active managers take advantage of that space to kind of go further afield and get access to additional liquidity, which could give them a benefit and say, you know, I'm going to outperform the index. Doesn't necessarily mean that they were like trading in the index. They were going beyond and going to other pockets of you know, securitized. I do think we see a trend over time of ETFs eventually going into further and further pockets of the fixed income market. And you know, things that might seem less liquid and might seem difficult for ETFs to access now, I would expect that you would see over the coming years there's going to be more and more traction in those type of products.
100% agree. And there definitely are securitized ETFs or CMBS ETF. There are mortgage ETFs. Agree on the asset-backed side, maybe a little bit trickier. And I think what's interesting about those products, as I said at the beginning, the use case for those products is a little bit different. I would venture that very few people in this room own individual mortgage pools in their diversified personal accounts because they're really hard to buy individually. The same is true if you're an institution. To own and acquire that many pools and manage the risk is similarly difficult. And yet, in a world where companies are getting more in debt, you're perhaps worried about triple Bs. Maybe you want more mortgage exposure in your portfolio. So a great way to do that, an efficient way to do that, an operationally smoother way to do that could be through something like a mortgage ETF. So again, it goes back to sort of thinking about the use case and the reason why you might put an ETF in your portfolio.
Yeah, just one shameless plug from me. We actually launched a Mortgage Plus Bond Fund
There you
today.
go. You're loud.
If there's interest there, so this is an actively managed ETF through a partnership that we have with Voya Investment Management. So my shameless plug of the panel. So with that, I'm getting the time's up. That's it. So wanted to thank you again all for the time. Thank you so much for the time. For the
Thanks,
panel.
guys.
We hope you enjoy it.
Thanks.
Thank you.